Hello and welcome to Live Wire Markets. My name is Chris Conway. On today's Views from the Top, I'm sitting down with Chris Nicol from Morgan Stanley. Chris is the head of Australian Strategy and Macro. Chris, thanks so much for sitting down with Live Wire.
Thanks very much, Chris. It's good to be here.
Can you tell us a little bit about your background and how it intersects with Morgan Stanley's approach to investing?
My background has been in markets for over 25 years now. Started as a sector analyst, if you like, when I joined the research department at Merrill Lynch. Worked across a number of large cap sectors, took some of that experience and built a small cap franchise that gave me overall perspective, I think, to the market in many different ways, and then made the shift to Morgan Stanley almost 15 years ago as a small cap analyst, and then through that journey took myself into the macro role about 11 years ago. And the real thesis of us rebuilding that team, if you like, was to actually take a top-down and a bottom-up perspective. So we often say that we're macro-aware and stock-driven. I have the economics function, the quant function, the market analytics and index functions all sitting in with my team with the equity strategy piece. And we think that holistic macro approach actually enables us to get in a conversation and dialogue with our clients about their process and on what they're trying to do, which is trying to make money and beat the market. So we think that blend of approach is somewhat different. And Morgan Stanley's an agency business. We make money by making good ideas for our clients, and that's what the macro team's been set up for.
Chris, you're on record as forecasting the RBA not cutting until May 2025. Why is it that you think that they can't go until then?
Yeah, so I think we've seen a real evolution from the RBA, not just because of the review, but this whole concept of data dependency needs to be taken seriously. I think if you think about the objectives that the RBA, in my opinion, needed to address, one was around the clarity of communication, but it was also the integrity of forecasting. And certainly the clarity is being addressed with the change in meeting profiles, with the way that they're dealing with the media and the press on a more regular basis. But at the same time, they're saying that they're data dependent, and they're saying that their forecasts have integrity and need to be met. When you look at their forecasts, and they've given themselves to the end of 25-26 to get into achieve their inflation goals, you look at the run of data that we're getting, particularly around jobs, and now even a little bit of strength in retail sales off a low base. There's not a lot to suggest that this bank is in a position to need to start easing. And then when you compare the RBA that sits at a relative level of cash rate that is nowhere near as restrictive as other DM peers, the consequence of lagging the rest of the world in terms of raising rates means that on the way up, means that you'll probably lag on the way down. And bringing that all together, we've got May 2025 as the first point of easing for the RBA.
Chris, just to follow up there, if I may, if and when we do get that first rate cut, thereafter you think it will be a shallow cutting cycle or normal, or a deeper cutting cycle?
Yeah, so probably shallow to normal at this point. One, our inflation picture is a little bit stickier, but thanks to sort of rents and wages, and that's going to keep their challenge a little bit higher. We're also, as I said, we're not as restrictive as other central banks, so therefore we get back to neutral arguably a little bit quicker when we do start cutting as well. And then we do have the re-acceleration risks that I think will sit across most economies, particularly if soft landings play out in many markets. You're going to have a central banking system globally that's going to avoid any excessive re-acceleration. They don't want a repeat of the Volcker years in the first instance. So I think every central bank's on notice for that. Our RBA wouldn't be on its own in that view.
Chris, let's talk about the Aussie dollar. You've talked about it hitting 70 cents against the US dollar by the end of the year. What impact would that have on the economy and then on the RBA as well?
Yeah, look, I think it's the way we look at it. We said Australia could be living in the 70s, which is some people might remember as a good Skyhook song. But if you think about the direction of travel for currency rather than the point estimates, we've been in a long period where direction of travel has been lower for various reasons: China growth, commodities, all the things that can drive that. The currency, I think, typically works in a two-factor model: interest rate relativity, and also your expectation on growth, global growth, but particularly China growth. And we think that the relative interest rate scenario for Australia, lagging other central banks in terms of easing, will put upward pressure on the currency. And at the same time, with the stimulus that's come from China, and probably more so a global soft landing, actually puts a bias towards the currency to move in that direction as well. In terms of the RBA, there's real incentive also to see the currency move up a little higher, because that takes away any risk of disinflation stalling. So you're not going to have inflation start to pick up because of imported currency if we can get that back in to the sort of low 70s. So Morgan Stanley sees a sort of 72, 73 cent by the first half of next year.
Chris, let's shift the focus to the Aussie equity market. It has become quite concentrated and quite bifurcated. How challenging has it been making strategic decisions in a market like this?
Yeah, I think as we've seen the sort of melt up in equities, globally, narrow attribution has been a real feature across many markets, and Australia hasn't been on its own in that front. The way I kind of look at it at the moment is I think that whilst you still thought there was a risk of a hard landing, either offshore or onshore, you tended to look for some form of protection and exposure. And in Australia, that seems to have correlated into large cap, top 20 liquidity in the first instance. It's then had in some cases, had a yield attached to it, which possibly explains certainly the start of the year to this year's performance in banks, as you've got both protection through liquidity, and you've also got a compressed yield environment. We can talk about how fundamental we think that is, but that's actually what's happened. And so you've had to be aware that also momentum has been, as a factor, has been such a big driver across the market as well. So where these winners have started to capture in, a lot of Australian industry sectors are quite narrow in terms of opportunity set. And I think the statistic that I didn't come up with but saw was that over a period of time, if you just bought the best performing, most expensive stock in every sector over a 12-month view, you would have done okay. And that explains some of the narrowness. Is it challenging? Yes. But we haven't really had the broadening out of opportunity, the confidence to go and search for that. And softer landings with a degree of easing, better commodity signals, maybe better conditions coming out of China than feared, all of those things might actually open up markets to a broader set of equity opportunity, which is something we're talking to clients about.
So that rotation that's happening at the moment, you think that this could further unfold?
Look, certainly, potentially from here, we did see a couple of weeks ago a fairly graphic move in what could happen if we got more conviction on what was happening in the world of commodities and just the relative underperformance. I mean, resource sector versus bank sector, the peak underperformance was about negative 66%. Right. I don't think I've ever seen that in my career, and it was quite distortive in terms of the way people were thinking about opportunity. Soft landings and what we're seeing early days out of China and stimulus give me some conviction that we could see more rotational opportunity emerging.
The consumer been at the forefront of the economic narrative and story over the last 12 to 24 months really. How is the Australian consumer faring, and how is it impacting the sectors in terms of consumer and discretionary?
Yeah, I think we have, and people that follow our work will see that I've probably been called the boy who cried consumer. Just seeing interest rate rises, expecting that to bite into the economy. When I try to back solve that over caution that we had in terms of actual delivery of earnings for those sectors, it really came down to that people kept their jobs, and we saw a very strong jobs market. Labour force integrity was critical to consumers being able to use their buffers, and at the same time, even now, probably use some of the stimulus that's coming through. So the sort of consumer environment I think you've got at the moment is what we call a thrifting environment, where consumers are definitely changing behaviours, whether it be buying cheaper beer, whether it be looking forward to shrink the amount of purchase at the supermarket, or less discretionary in certain areas. I think all that's playing out. The risk of chasing a cyclical recovery in those sectors at the moment is that thrifting, because of our view on the RBA, is probably going to last a reasonable time frame and could actually be a bit of a drag going into this Christmas. Not a complete collapse of spend, but certainly no real reason to expect consumers to suddenly accelerate what has already been a pretty meaningful change in behaviour. So a bit of a muddle through, Chris.
Yeah. Chris, the model portfolio, you referenced before, underweight banks and overweight miners. Has it been a trade that's hurt a little bit, and are you sticking with it?
Yeah, so it definitely has been a pain trade for a good part of the year. Yeah. We were expecting to see maybe some give back in just the relativities in terms of performance. Why are we still sticking with that view that there is more rotational opportunity? I think steps back to the way you need to think about resource investing at the moment. Firstly, when we were go back 6 weeks ago, when I'd argue we're at peak bearishness, a lot of the commodity prices were testing their cost curves pretty aggressively. And that to me says that you're testing a harder landing scenario. You're looking for reasons to crystallise the demand destruction that you're fearing. Now that we've got the Fed easing, softer landing in the US, You've got China easing both monetary and fiscal. Quantum is still an open question, but still a change. You start to bring softer landing scenarios back into the equation. That's important because that allows the commodity signal to start to bounce, and that we've definitely seen that in iron ore, we've definitely seen that in copper, etc., over that period of time. Then you go back to actually what's been the fundamental shift this cycle for resource investing, and it's got a lot to do with supply and the lack of investment. So if I'm not seeing demand collapse to my bear case, I know that there hasn't been enough investment, there isn't enough supply, and therefore the commodity signal can be somewhat more constructive. And again, that relativity of performance within the Australian barbell of banks and resources gives you some perspective that it could start to close, but also the free cash flow and the earnings for this sector might start to improve as those spot increases in commodity turn into better averages versus consensus. And that gives me some comfort as to keep the pain trade on, if you like, and try and get some of that performance lost.
Chris, I'll just follow up again there. The China stimulus, there's been a couple of announcements. Obviously, there's been some quantum mentioned, as you talked about. Where do you think we are in that evolutionary process?
Yeah, so I think, look, one, Fed easing has allowed the PBOC to clearly adopt its own form of monetary easing. And that, to be frank, I think was fairly well expected on the buy side. As it came through. What seemed to surprise markets, both offshore and onshore, was the speed to which there was signalling around fiscal intent. Our China economics team and Asia economics teams have pointed out over the last week or so that there is a clear change in messaging that says deflationary impacts across the economy are not only being observed but are now probably more cause for concern, and therefore policy will adjust. What I think we need to just step back from is to say, why would you have a big bang stimulus like 15-16 in terms of announcement and the way that it plays out when this is a long-term challenge that needs a long-term solution? What I'm encouraged about is that the narrative has shifted. They've made some fairly significant statements around intent, and I think the market is going to be watching over the next 6 to 12 months that policy evolution. The first one that I took comfort in was the fact that the central government is now taking on debt from local government, and that's a big change in shift of the fiscal austerity measures that have been in play, pretty much since the reopening. So we're watching for those signs, people wanting numbers in the next 6 to 9 days. No, I think take the next 6 to 9 months, but do respect that the narrative is not just subtly shifted, but looks to have some durability to it.
Chris, whilst you're overweight materials, you're also overweight defensive industrials with a big overweight in telcos and infra and utilities. Can you just unpack that for us?
So Chris, I think the way we've talked a lot about the commodities and resource positioning, it's about where we are in the performance gaps, where we are in the commodity cycles, and the relative value that it was offering, I think, and that's really driving the overweight there. We're not calling for outright super cycles in commodities and or demand conditions, but the opportunity is there. We have held idiosyncratically across stocks within each of those sectors in those defensive industrials that are probably more exposed to lower long end yield curves. So if the US 10-year continues to fall to levels, sub 4%, and structurally remaining below there, we felt that there was some valuation upside for a number of those names. And I still have in the back of my mind that the world isn't linear and there will be a choppy outlook. And I would expect that having some form of defence in a portfolio here kind of makes sense. Mm-hmm. And across those three particular sectors, and also a little bit of REITs as well, is we've found that sort of defensive overlay that gives us some comfort to ride the chops out.
Chris, let's talk tech and healthcare. Tech has been an outperformer. Healthcare has been an underperformer until this year. How do you compare and contrast the investment case for each, given the historical growth credentials?
Yeah, so typically we've seen, if we take the yield curve signal, we've seen steeper curves in general over the last sort of couple of months, and that's the short end leading the long end, and usually leads to healthcare outperforming over the history of other periods of where we've seen that signal. I think what has hampered the healthcare space in certain names has been a good dose of disruption. And so whilst healthcare for a long time was treated as a long-term compounder, premium to the market, but high quality in terms of earnings, we did start to see the quality of earnings, certainly delivered earnings, start to move around a bit and quite a lot of movement. And for a while there, even from the quality factor, if we put our quant hats on, healthcare wasn't actually being represented in that basket. So I think that investors were of the view that there was a bit more volatility and a little bit more risk across the space. And again, they're idiosyncratic names, particularly in the global health names. You also had domestic healthcare under its own earnings pressure, whether it be hospitals or insurance. There was a lot of questioning about how those economic models were evolving. So what you had then on the flip side was this little thing called the tech sector in Australia, nothing like what we have in the US, obviously, at 2% of the market, now running close to 5-6%. And so there's a lot more opportunity set, or maybe liquidity opportunity, because these stocks that have come into the 100 are now, very valid investment cases on ability to get in and trade, etc. So institutional focus has only increased there, and some of those stories were showing structural tailwinds and opportunity where people could buy in and pay even a premium to healthcare multiples, in some cases much bigger premiums to that. So the way I kind of look at it now, when I'm looking, when a broker comes into you and says you need more quality in your portfolio, you're probably needing to add healthcare and tech together, and looking at and then throw in the portals and throw in some of the global growers and think of it that way, than just thinking that it's going to be at a gig sector relevant call. I think it's going to be more around where is the quality growth, who's compounding, and finding ways to get exposed to that.
Chris, let's talk franking credits. There's a lot of Aussie companies that are sitting on some big war chests. What opportunities does that create, and what are you getting after?
Yeah, look, it's an interesting concept, because from a franking credits perspective, the value of those credits is not often put into models or assessments of valuation. Okay. It's usually left to the person that receives those to form the value. And so we've updated analysis for over the last 10 years of looking at where some of those initial excess balances are, and seeing across those sets as to whether they'd ever be released. Now, up until recently, you were able to use off-market buybacks to distribute those, and so any sort of structural changing event or asset sale, those sorts of things, were able to, you go run a buyback and you'd be able to run a very investor-friendly approach to distributing that war chest, if you like. Now that distribution has been siloed effectively to dividend distribution in isolation, and so companies now have to ask themselves, now I can't do the big off-market buybacks that are tax incentivised. I'll still do my on-market buybacks and maybe the odd off-market where you've got a lump of cash come in. But is there another way to send a message to your stakeholder base around your confidence in outlook? And could that be the emergence of a small special component to the ordinary component? And we saw that in the results season on a number of occasions. And the expectation is starting to build that maybe that could feature, because if you just pay them once, a special once, it's a sugar hit, it doesn't get reflected in long-term re-rating. Yep. But if the market starts to think that you have multiple periods of optionality to pay over and above your ordinary distribution schedule, that could actually be a re-rating event for certain stocks. So I wouldn't want to call out opportunities per se right now, because it's only one period that it started, but I do think it's something we need to watch into the next result season and the next result season, and have active conversation with our companies about what they may do with those balances.
Just on that, Chris, if you don't mind me asking, I was going to ask how many periods would you want to see the specials being paid before you started to gather some confidence. So what element of it is that, and then what element of it is the conversation?
I think it's the conversation in terms of, well, the corporate strategy around capital management is going to be critical. So how are they assessing their allocation of cash, capital, and how does franking play into that? And some will not be in a position to distribute those for a number of reasons. And then I think it's then to look at the duration or the durability of that. So, and I think the ones that'll be rewarded, and I've seen over my time, even in small caps, where they found themselves in a position to actually be able to pay over a long period of time, it became an endearing feature to the investment case of the stock. So I think it's an evolving dialogue that starts with communication, then turns into formal approach to capital management, and then assess that to see how it goes.
Chris, the 12-month forward yield for the ASX 200, 3.6%. It's the lowest it's been in a long time. We know that Australian investors love their yield. What would you say to investors who are looking at that yield and thinking it's not as high as it used to be?
Well, it's the P. It's the price we're paying. I think the market is just slightly above our price target of 8,100. Yep, we got there, well done, but earnings are 20 to 25% lower than what we thought they would be. Right. It doesn't make me feel super comfortable about that. So we've had a compression of yield. If you look at payout ratios, they're pretty much in line with long run. In terms of dollars paid out, slightly less than certainly some of the post-COVID initial rebounds, but on a 2019 basis, not too far different. Payout ratios do appear maybe in some of the higher dividend paying sectors, not as high as they were in prior peaks as well. A better economy and maybe a rate cutting cycle and a cyclical evidence in the economy, you could start to see companies paying out at a payout level, maybe slightly more than what they had. That would help this. But I think the reality is, earnings recovery is going to be critical with the payout ratio being maintained, with a little bit of flex in payout ratio should conditions really do start to improve on an easing cycle basis.
Chris, the segment that you're participating in today is called Views from the Top. What's the one thing that you've learnt over the journey that you wouldn't have learnt if not for the path you've trodden?
Thought about this question as I've seen you've asked it before on other sessions, and I was thinking that some perspective that I would sort of take is I was chatting with an old CEO friend of mine who's now retired, and we were talking about how longevity and sustainability of career in investing and staying within markets, and he made the point out to me that the day you stop learning is the day you probably need to change. And then I thought about what gives you the ability to keep learning. And I think that's got a lot to do with curiosity. And I think in markets, you need to be curious, not just in the job you're doing at any minute, but you want to be interested and curious about the market around you, the sectors that are interplaying, the trends that are evolving, the history that gives context to that. All of those things are necessary. That curious nature will keep you investing and keep you looking for ideas. And then I think by doing it for a long time and probably trying to learn too much and not remembering enough and all the rest of it, my key message would be learn how to not only distill a lot of information and sometimes quickly, but learn how to dismiss certain things as non-issues. And I think that to me has been a real characteristic that all the people I've worked with tried to say, there's so much out there that you can learn, there's so much out there you can be curious about, but it's that ability to be able to distill and dismiss and focus on the stuff that's going to add value to whatever challenge you're being confronted with in investing landscapes. That would be my view from the top, if you like.
Chris, I'm going to bring this full circle because I remember at the top when you were talking about the macro and the quant and all the different departments that now report into you, and I was thinking to myself, how on earth does he stay on top of all of that? And you just explained it by saying you got to figure out the wheat from the chaff. So appreciate that. Thank you so much for sitting down with Overweight today.
No, thanks, Chris. Great to be here. Thank you.
If you enjoyed that Views from the Top as much as I did, make sure to give it a like and don't forget to follow our YouTube channel because we're adding lots of great content every single week.